Alexandria real estate equities is starting to become quite interesting at its current prices, and let me show you why. To start off, if we jump over to my dividend breakdown sheet, we can see that starting dividend yield is high. It's about 7.25%. On a forward-looking basis, it's probably closer to 7.5%. If we look at the dividend history for the stock, we can see a great history of growing those dividends, even during 2020, which was not very common for most real estate investment trusts. If we look at the insider activity over the last 3 months, we can see there's been 15 separate buys and only 3 sells, and insiders have bought nearly 80,000 shares, while the number of shares they've sold is only a little over 2,000. And if we look at analyst price targets, which admittedly I'm not always a huge fan of, but we can see the lowest price target from analysts is currently $74, which is still higher than the current share price for this stock. Keep in mind, the average price target is around $95.14. So simply by looking at some of this data, you can see why ARE is an interesting real estate investment trust at its current prices. And in fact, to add fuel to the fire, look at the historical price to AFFO model that I've built out. Again, remember, price to AFFO. AFFO is one of the most important metrics for a real estate investment trust. It's kind of like if we were looking at earnings per share for a more typical stock. So if we're looking at the price to AFFO multiple, it's like looking at the PE ratio for a stock. And if we zoom in, we can see the historical AFFO per share over the past decade for this stock. What we can see is every single year this has been growing, and that's exactly what you want to see out of your REIT investments. But here's what's interesting. If we look at the historical price to AFFO multiple, which again, remember, this is a valuation metric, we can see it climbed pretty high, and at 2020, it reached a peak of 24.84, which it does appear quite a bit high during that time. But over the last couple of years, it has come down drastically. In 2023, it got as low as 11.92, and in the trailing 12 months, it's now all the way down to 7.67. Keep in mind, the average price to AFFO multiple over the last decade is 18.37. So from a P to AFFO multiple valuation perspective, this stock is more than 50% cheaper than it's historically traded over the past decade. So what's going on with this stock? Is the sell-off justified, or is this a massive opportunity? If we look at ARE over the last 5 years, it's now down by about 55%, and in the last 10 years, down 22.76%. But keep in mind, there was a time where they were trading in the $80 range and got as high as about $222 per share. Now, I will quickly mention one of the reasons that I do like dividend investing in general is because even though the stock price over the last few years has gone down, they've been paying out big dividends. Those dividends have been sustainable, and they've continued to grow those dividend payments over time as well. Something to think about. Now, let's go ahead and jump over to the annual report for this stock. And what do we know about ARE? Well, this is a specialized REIT focused on owning and developing office slab space for life science, biotech, agtech, and technology tenants, primarily in places like Boston, San Francisco, and San Diego, and some in New York City. And one of the first things that ARE boasts on their annual report is how they've been able to grow funds from operations on a per share basis over the past few years, and I will say it's actually quite impressive. We can see the 5-year growth is about 36%, and the 1-year growth, which is about 6%, which is pretty decent for a REIT. Now, it's extremely important to note that the metrics we're looking at here are on a per share basis. Why is this so important? Well, we have to remember how REITs operate. REITs are required by law to pay out 90% of their earnings in the form of dividends. So what does that mean? Well, it means they don't have a lot of capital left over to reinvest back into the business, so typically they have 2 options. 1, they can take on new debt, or 2, they can issue new shares. So if we jump over to my stock screener from Ticker Data and plug in ARE, the data will load in thanks to Ticker Data, and if we come down here, look at shares outstanding for ARE over the past decade. Now, typically when we look at a stock that has this type of share dilution, it is a major red flag, but that's not always the case for real estate investment trusts. We have to remember why they do this. They only have 2 options to raise capital, and so oftentimes when interest rates are high, instead of taking on debt with high interest, they'll typically issue new shares. But because they typically issue so many shares, we can't just look at funds from operation or adjusted funds from operation. We have to look at how it's growing on a per share basis, because technically funds from operations could be growing every single year, but on a per share basis, the growth could be much slower. But what we're seeing from ARE is that even though they are issuing new shares, which again is pretty typical for REITs, they're still able to achieve pretty healthy growth rates. And to put this into perspective, they've been able to grow funds from operations on a per share basis much faster than their peers. Now, one of the things we have to remember is a REIT is only as good as the tenants in its portfolio, and we're going to be talking about that a little bit more later in the video, but one of the things that I do want to point out is they are in the top 10% credit rating ranking among all publicly traded US REITs. So generally speaking, they have a much higher credit rating than most of their peers. Again, that's a good sign. But while we're on the subject of tenants, here's where some people are starting to have some concerns about ARE. If we look at the last 5 years, they've had pretty consistently high occupancy rates with an average of about 94.5% over the last 5 years, and it hasn't varied too much year over year. But if we look at a quote from the recent earnings report, here's what we can see for guidance in 2025. Occupancy guidance for 2025 was lowered from 92.4% to 91.7% due to slower than expected leasing activity. Obviously, that was not something the market liked. And one of the things you will notice, occupancy guidance was already projected to be lower than their average, and they still revised it even lower. Again, over the long term, a REIT is only going to be as good as its tenants, and if those tenants struggle to pay rent, or if there's not enough tenants in general, then that dividend will always be at jeopardy. But here's some of the good news. 80% of the leasing activity is already from their existing tenants, so as long as companies like Johnson & Johnson and Pfizer continue to stand strong, then ARE still has a foundation of stability. This was also addressed in the recent earnings presentation. The CEO highlighted that ARE's strategic focus on their mega campus model, emphasizing that 75% of their near-term development pipeline for 2025 and 2026 is already leased or under negotiation. And these are projects that he believes are expected to contribute significantly to future growth. In that earnings report, they did also change their guidance and stated they now see full-year adjusted funds from operations of $9.16 to $9.36. Now, this is really valuable information because we can actually see whether or not they expect the REIT to actually grow. So if we jump over to Seeking Alpha, let's jump over to financials and scroll down to the bottom of the income statement. Again, we're looking for adjusted funds from operations. And we can see this metric right here. And if we look at it charted out, again, we can see it's grown very steadily every single year, which is very impressive for a REIT. And 2024, it came in at $9.47. But the guidance they're giving us now is about $9.16 to $9.36. So it looks like 2025 has the potential to be the first year in quite some time that this REIT really doesn't grow adjusted funds from operations. And so one of the questions we need to ask ourselves is, what does that AFFO payout ratio look like right now, and how will it be impacted by a lower AFFO in 2025? And if we jump over to the dividend safety tab, again, we don't want to look at the earnings payout ratio or even the free cash flow payout ratio when it comes to real estate investment trust. Again, we want to look at the AFFO payout ratio on a forward-looking basis. And on a forward-looking basis, right now, it's sitting at about 73.23%. So again, that dividend is very well covered, especially for a real estate investment trust, and historically speaking, they've been able to grow it at a very healthy rate. Now, if AFFO isn't growing, then it's quite a bit more difficult to actually grow that dividend without increasing the payout ratio. So it's certainly possible in the next year or two we could see lower dividend growth rates from ARE. So with all that being said, is this much of a sell-off justified, or does it create an opportunity to buy a high-yielding REIT that grows its dividend over time? Before we answer that question, there's a couple more things that I want to point out, and this is actually something I was writing about over on Dividendology.com just the other day. To start off, only 35% of their assets are financed with debt, meaning there's less risk from debt obligations. Also, the interest rates on ARE's debt are already locked in, so the interest rate risk for ARE is much lower than most REITs. And then finally, ARE's buildings are coming back into demand as the AI-driven biotech boom starts to grow. So now let's go ahead and jump over to our REIT valuation spreadsheet to see if we can find the intrinsic value. I'll plug in ARE and hit enter. And again, thanks to ticker data, all this data will automatically load in. Now, like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, the first valuation that we're going to look at when it comes to ARE is going to be the AFFO multiples valuation. Basically, what we're doing is we're looking at how the market is valuing companies that are similar in structure, and then comparing that to how ARE is currently being valued. So if we look at these similar companies, we have Healthpeak Properties, Omega Healthcare, Kilroy Realty, we can see the average price to AFFO multiple for these REITs is about 11.55. Now for ARE right now, it's sitting at just 9.68, which is dramatically lower than its historical multiple. But if we were just to simply apply the same average PAFFO to ARE, we'd come to an intrinsic value of close to $86 per share, quite a bit higher than that current share price. Moving forward, if we look at the historical price to AFFO multiple valuation, which we already looked at, like we pointed out earlier, right now for the trailing 12 months, the P to AFFO valuation is 7.64, which is dramatically lower than what it has been over the last decade. So compared to its historical valuation, it's dramatically undervalued. And then finally, if we look at them from a dividend discount model, again, the idea behind a dividend discount model is we can value a stock based on how much it's paying out in dividends right now and how much that dividend will grow in the future. And right now, if we look at it from a reverse dividend discount model perspective, if we assume just 0% dividend growth, this REIT would be worth $61.06 per share, which is fairly close to the current share price. Now, historically speaking, the REIT's been growing dividends at a rate of about 5% over the past 5 and 10 years, like we've already pointed out. So what happens if the REIT is still able to grow dividends at a rate somewhat close to that over the long term, maybe 3.5%? All of a sudden, we come to a dividend discount model price per share of $107.43, basically 50% higher than the current share price. What does this tell me? Well, if ARE can get their occupancy levels back to where it was over the last 5 years, which it looks like management is aiming to do, then this REIT could be trading at a massive undervaluation. Now, to be clear, I think dividend growth might be a little bit slower in the next couple of years, but by the time we hit 2027, I think dividend growth could ramp back up. So if we jump over to our output tab, let's go ahead and zoom out and look at these two valuations, AFFO multiples and the dividend discount model valuation averaged together. We come to an intrinsic value of nearly $97 per share, but the current price is about $72, so that's a difference of 25%. So with a 10% margin of safety, we're still within the acceptable buy range at about $87, and with a 20% margin of safety, the acceptable buy price is about $77.35. Again, getting a buy signal even with a 20% margin of safety. So when I look at ARE, yes, there are some headwinds as with any stock that's seen a major sell-off. The question we have to ask ourselves is this a short-term headwind or is this a long-term headwind that's going to continue to adversely impact the stock? And when I look at ARE, I think over the long term, they're going to continue to be able to grow their adjusted funds from operation. Right now, they easily have sufficient dividend coverage. And so the reality is you can sit back and enjoy a high 7.5% starting dividend yield while you wait for this REIT to turn things around. The caveat to that is you do need to closely watch what actually happens to those occupancy rates over the next couple of years. But go ahead and let me know what you think of this high-yielding REIT in the comments down below. Also, be sure to check out dividendology.com at the link in the description. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.